By way of introduction, to my immediate right, we have Robb, CFO of AXA XL, Jim Nadler, the President and CEO of Kroll Bond Rating Agency, and finally Jeff Sangster, CFO and Head of Strategy at Hudson Structured Capital Management. Welcome and thank you for joining us today. I appreciate it.
Thanks, Matt.
Thanks. Capital management is obviously central to the reinsurance industry's value proposition. So could we start by getting your views on the different levers, the different approaches and levers that companies can pull in optimizing their capital strategy, and what are the advantages that companies are truly striving for as they look to optimize their capital? And Steve, could I start with you?
Sure. I mean, the questions around capital for any financial services company, but in particular insurance and reinsurance, are sort of omnipresent for all of leadership, but in particular for the finance leadership. How much do we have? How much do we need? How much do we want? What form should it take? And over the last number of years, every one of those questions has become more interesting, more complex, and with more levers that one might be able to pull, whether it be on the regulatory side and a move more towards internal model-driven capital requirements, how much you need, or the ILS market, the alternative capital market, the various forms in which and types in which we can get capital, or how much we have become, I think, both challenges, opportunities, levers, if you will. When I look at the capital as a rule, I guess I divide it into buckets of concern. They're all interrelated, but they nevertheless I can compartmentalize them. And maybe the first is the solvent lens, the prudential lens. How much do I need? I don't want to have too much. I don't want to have too little, but I need to have enough to meet the needs of my policyholders, of my stakeholders. The second is probably the profitability or earnings lens. Does my capital, the nature of the capital, the amount that I keep, is it reflective of the product? Am I making a return relative to the capital that product demands? And how do I best assess the capital in that lens? The third might be the structural lens, and here is one that people pass by a fair bit, which is where within a global organization, and many of us are parts of or operating organizations that operate in many jurisdictions around the world and in many forms of business. And so where does that capital sit, and how do I structure my company in ways that I can move that capital, create its fungibility in ways that are really, really helpful? The form of the capital, I mean, increasingly, and Bermuda is an important part of that, the expansion of that, but increasingly it's not public capital, debt, balancing your leverage. It's your use of traditional reinsurance, your use of alternative capital in various sources, debt, equity, forms thereof, and how do I ensure that I'm aligning not only that capital for the best return for my company as a whole, but increasingly, and here's where Bermuda's played a big part, for individual components of my business, there may be a better aligned capital than the homogeneous capital that I have for the group. Okay. And how do I think about that? So I think in each of those cases, each of those different lenses, I have varying different levers that I can use, and the world is becoming more and more, I say complex, and that sounds like a bad thing, certainly more interesting in the numbers of options that we have. And central to that, I think, is the increasing, and that sounds like it's new, but it's not, but the relevance of having a central view of capital, a central economic capital model, a central North Star that you as a company can look to and say, okay, there may be different measures, a rating agency, a regulator, or someone else, but to that North Star I can point and look at my differences from there. So I think having that is the most important tool or lever that you can have, and being able to reference that.
Jim, Steve mentioned sort of the importance of capital management from a solvency perspective. Obviously, a rating agency obviously has a big lens from that perspective. Are there other advantages that you see companies have that actually employ their own internal model?
I do. I think that one of the problems that legacy rating agencies have caused in the insurance industry, and it's particularly acute in the reinsurance industry, is this notion of these static models that they develop, and these models last for 5 years, 6 years, 7 years. So you look 2 years down the road, and you've got a company that is, using technology to advance their capital optimization models throughout the organization. And they're doing very well, and then they've got a team that is working to fit their new business model into the rating agency's capital model from 3 years ago or whenever. And so I think it's important that the rating agencies become less married to their own capital models and begin to look at the internal capital models that the companies have and assess those relative to the risk of the current environment. Look at their capital structure, look at the risks of the current environment, and assess that relative to their capital model and their optimization, and not impose their own view that, frankly, a lot of times is antiquated.
And presumably constrains some of the companies.
Picking up on Steve's comments, agree the options around capital management are far greater than they were 10 years ago. A couple of examples, but I think also the availability is something that we have to be aware of. That those levers are there, but they're not always as available or as available at a price that's economical. Retro is a perfect example where that was a capital lever that reinsurers were definitely pulling in over the last decade more and more. And for me as a CFO, it was a lot easier for me to call up my retro buyer and say, go to Fund A, some of which don't exist anymore because it was too cheap, and buy cheap retro, rather than go out and go into traditional capital markets. And so that's something that now, in going into 1/1, that's not going to be as cheap as it was in those days 5 years ago. And so potentially that lever is a little further away and harder to reach for that capital manager. In a similar vein, the legacy business has moved away from being the insolvency business and actually can be a useful capital management tool for a capital manager. And that's that is a bit of a plug for the runoff industry, and I'm not being paid in cash or in kind for that plug. Can't get through this week without a rugby reference, for those that But that's something that's become more and more prevalent, where a business looks at a book that is consuming a lot of capital but not meeting returns, and they're able to now, there are a number of options at almost any size to go out to a legacy provider and find a price for that book of business that can free up that capital. And that's something that, again, that has been a piece of the market for decades, but hasn't been as prevalent in the live market as we see it today.
So in relation to that, Jeff, are you looking at from the perspective that alternative capital plays an important part in the reinsurance market today in comparison to a couple of decades ago? And at the moment, in the alternate capital space, we have a lot of trapped capital based on the 17 and 18 events. Are you suggesting that there's some kind of emerging solution on that side of the fence to help unlock that capital and redeploy it? Is that a missed opportunity at the moment?
Yeah, I think it's not unlike the legacy market. It's just a market that hasn't developed yet. In my mind, there's a price for everything, and if there's trapped capital, and the owner of that capital wants to redeploy that and get it back so they can redeploy that, there's a price they'll pay for that. To date, there hasn't been the bid ask just hasn't been closed to the point where somebody has come in and said, the discount that we will pay you for this to remove that capital, give you that capital back, and take the liability away from you. That discount has been too great, or so it would seem, to those holding that capital, and then thus the market hasn't happened. It's a distressed asset in a way. It's going to have some discount to it because if it's trapped, somebody believes that there's uncertainty around it, but it just hasn't developed. I think it's something that as this problem issue continues to evolve, there will be solutions come to the fore, and I think I think there is an opportunity there. Obviously nobody's figured it out yet.
Doesn't the natural solution for that, ultimately be the cedent themselves? As they look at the amount of wanting to renew that alternative capital, and the fact that their current provider can't re-up because they're in that position, a negotiated release of that is implicit in facilitating the ongoing coverage seems to me to be the natural discussion. An outside market might come into play that, but like you say, finding a price point for that and that short duration is probably a tough thing to put energy towards.
Yeah, obviously commuting it is with the cedent is the easiest answer, but that's not always in their motivation either.
Not their motivation, exactly. Well, what I was hoping to turn to now is just where capital management has come from and where it's potentially going. We heard Paul Brand earlier on said that there are some companies that are out there that still have a tendency to fit their decisions to the models that they've already built, as opposed, I presume, from building the model and informing decisions. Has capital management sort of improved? Has it moved away from being a view on what your solvency position actually is to being something that can actually drive and inform your strategy and your business decisions into the future? Do you agree with Paul's earlier comment? I guess is where I'm
I certainly, Paul's comment has relevance, and I don't know how many regulators there are in the room, so I won't question the use test. I mean, essentially, if you're not viewing your model as something that is meaningful in helping you make decisions, implicitly your model may struggle to be successful as a tool to be used for regulatory purposes. So there is inherent in the process that regulators, and likely as it emerges with rating agencies, and they think about it, that if you're not using that model as a means of making decisions, and those decisions, I think, need to extend fully to the decisions you make on the front end versus just capital structure and other decisions that are inherent in the business. And I do think that is happening almost uniformly. When you think about decisions being made that are driven by the old, on the CAT end, it was the decisions being made by AM Best, stressed BCAR, what do I buy, when do I buy it, what do I need, so that I can reduce my overall capital position. Some of that still exists, certainly, but I think as a general rule, if people are going to invest the time and effort to understand an internal model, to build one that is meaningful, if they don't use it in anger within their business, there's certainly a much higher degree of cost than I think should be borne by anyone. And for many of the companies that are not individual specialists, and even for those, where you are looking at essentially portfolio management. It's obviously the portfolio of risks that you take at the highest tower level, but it's the portfolio of risks that you take at the most granular product, subproduct, region. If you're not trying to use your models in anger to say which one of those is returning me overall better, both in its own right and then which is in a covariate right, how is it returning, then I think you're not using the tools that are available to you. So to Paul's specific point, I guess your question, yes, I think once you have a hammer, everything looks like a nail. So I mean, if I have a model that tells me that this particular business covaries very well against other business, I'm making decisions that are based on that, and sometimes I'm ignoring other factors in respect to that business. But I don't know that that's necessarily a terrible thing if your model is telling you that is a business that is a good partner to the rest of your book.
I agree. I just want to make one point. We're certainly seeing that. And the one thing I'll add is that we have seen a real advancement in data science tools and data analytic tools. And I think that's been the real advancement, where you've seen people better able to look at a set of data and make decisions and coordinate large amounts of data and look at them and use those to make more effective decisions. And so we're seeing, it's certainly uneven, but we're seeing advancement in that across the board with companies.
Yeah. And senior managers involving the risk team in significant decisions will push that risk team further to advance that discipline as well. If you're making large M&A decisions, and you're pulling a risk management team into that. If that risk management team tends to sort of stay within the cocoon of what we do is really just kind of the traditional view of the risk team, or we're looking at regulatory and rating agency models, and we're testing against those. Senior management pulling them into significant decisions and saying, we want your opinion on whether this is a good transaction for us to move forward with. That's going to push that risk management team further, because they've got to think about things differently to add value to that process. And so I think as senior management, that's part of our responsibility as well.
Great, thanks. Maybe we can come back to the technology angle. I think that many of us can see the advantages that some of these emerging technologies like AI could potentially have, especially in areas where we are modeling and doing scenario analysis, etc. But a couple of times today we've heard commentary, including from Dennis Mahoney, around that maybe a question: is it so much the technology, or is it the access to the underlying data that we need more of? Can I get your thoughts on that? Are we currently employing these emerging technologies well? Are we adopting them at an appropriate rate, or are we really just trying to get our hands on that data that will, unstructured data, say, that will give us a better view into the future?
Sure. I'm not sure there's a huge difference. I mean, I think a lot of the technologies that we're looking at deploying are technologies that allow us to aggregate, sort, compartmentalize, and get access to the data.
Okay.
So, I mean, I think technology, whether in AI or other places, serves both of those purposes. The data isn't entirely ubiquitous. It needs to be some way made reasonable. So I think that the question in the end for me is how aggressive are you, or how much benefit do you see in deploying money, resources, people, intelligence, technology towards the question of data and analytics, and how meaningful is that to you? I don't think anyone in this room would say that in the business of insurance, which in large part is managing uncertain risks and trying to create some element of predictability about those, or to create some element of correlation or that analytics isn't ultimately. Everyone who took basic statistics and analytics classes in university remembers that the correlation was at the heart of that, and that the regression. So I think nobody would say that that's not important. How one gets there and how aggressive you are to deploying that technology, I think, is going to differentiate people. Yet on the other side, large parts of our industry are heavily syndicated.
Right.
And you might argue that deploying my energy is there until they're fully deployed, until they're fully available and essentially following might not be a terrible option. I think in the long run that strategy never isn't going to play out.
Isn't going to play out.
Yeah. Sorry, go ahead. Well, I was just going to say there's no substitute for a management team, a risk management team, be able to look at curated data, model outputs, and make decisions. So I think anytime we start to think about modeling and curating data and being better at curating data as an end in and of itself, then you lose. And I think what we need to keep in mind, and we see this to varying degrees with different management teams, some do it very well, some are struggling and are working toward that goal. But I think making sure that your management team and your risk management team understand the attributes of the model and understand what went into the curating of data is crucial to making sure that you're then making the right decisions with the output of the model or the output of the data. And I know you hear people talk about it all the time, but I think that making that an important part of your management training and the way that you evaluate data in your company is important, because you do see, and we see this because we see various companies. It's not just the insurance industry; it's the banking industry. It's the structured finance industry. You see management teams that, to varying degrees, rely more on the model, and you see other management teams who are very good at understanding what went in, how the model was developed, and they do a much better job then of evaluating the output of the model.
Yeah, just similar point that technologies that allow us to collate, access, and understand our data will be helpful in all aspects of the business. Circling back to the technology point, the enabling technologies are the ones that are getting traction in the industry. Disrupting is, as I think somebody made the comment earlier, that on one of the earlier panels, that disruption is going to take a long time, and and in some ways, disruption is more a different business model than a different technology. And I look at something like Jim's business model that's challenging, a very kind of old and staid model around rating agencies. Maybe that's more disruption than a website that's that does a better job of connecting with the customer and has more real impact on how the business looks going forward.
Well, I'm going to turn to a question from the audience. The CEO of RMS said that capital requirements need to change to adapt to the emergence of the last few years' losses. Do you agree with this, or should prices be the thing to change? Would anyone like to tackle that?
Yes and yes. I don't know that there's an or necessarily there, and to the extent that the CEO of RMS is saying this, certainly would give you some pause to the question of do you need more capital. I think these two questions are two portions of the questions are so interrelated that it's hard to break them up.
As
certainly the most recent losses,
as in prices are going to start helping. Building in profitability through increased pricing is going to build your capital base.
Or the inverse. The more capital I need, the more I need to charge in order to feed it. Okay. But either way, I'm going to come to the same outcome. Certainly, losses of late would have indicated a few things. Things like California wild, less modeled perils that are taking significant losses into the industry that are meaningfully less. I'm not going to say less predictable, to be honest with you, because I'm not sure that even though RMS does a great job of ultimately providing models, there's uncertainty remains. But certainly, where that predictability, where the fortuity associated with those losses can't be as easily relayed to the market as it can be for windstorm loss. They have been more meaningful over the last number of years. Certainly, not just on the cat side, but certainly you've heard large loss has been a significant deteriorator in both short tail and ultimately long tail lines of late. In those instances, price, I think, will be the first reactor to ways in which to make those lines more profitable, to correct that problem necessarily than changing the way you think about how much capital is applied. As we said earlier, in the case of regulatory capital, in most jurisdictions now, take US aside, you're looking at an internal model assessed level of capital against which you are keeping your capital. And so these losses themselves will naturally feed into your parameterization, will feed into your model, will inherently change the amount of capital. So that happens as a matter of course in almost all instances. Specifically as it relates to cat, RMS has a lot to play in that, because most of our models tie into one of the major one of the major risk modeling tools, and therefore, I think RMS will play a significant role. But ultimately, price will be the solution in the near term. Capital itself is just a conduit to that.
Take a slice of emergence. Social inflation is a pretty common topic right now, and I think capital models, capital requirements have to be considering that more explicitly. Both social inflation in terms of AOB and kind of on the property cat side, or the property generally side. But maybe the bigger issue that is emerging, and we're seeing that with Q3 earnings announcements, and lawsuits that are the judgments that are just mind blowing, is on the casualty side. That there's been a shift in mindset in very recently, And whether we're seeing that, there's no cap model for large liability. Do we see that working its way into the capital requirements, the capital models, as we start to see what may be a different view of those risks?
Something that's a little bit inherent in that question is some kind of recognition that climate change has actually occurred. It is impacting the performance of the reinsurance industry. But at the same time, there seems to be a lot of political and social pressure on the insurance and reinsurance industry in relation to its investing and insuring of the fossil fuel industry. It seems to be rising on reinsurance agendas. I mean, can we take it that this increased focus on climate change is a recognition or acknowledgement by the reinsurance industry that climate change truly is happening and we've got to think about it for the future?
Yeah, I think ultimately when it comes to ESG policies around how we run our business, it's going to be the capital that drives it. It's the investor. If the investors say no, we're not going to support either public entities or with private capital companies that don't have effective ESG policies, then it's going to change the world. It's going to change the perspective on that. I think if the capital providers and the investors don't take a stand on it, I'm not sure how much it changes.
I think he's exactly right. I think we're seeing already regulatory interest in ESG. So it's almost irrelevant whether you believe climate change is happening. What's really what we are focused on is regulatory bodies are getting involved. ESMA in Europe is mandating that companies change their businesses with respect to ESG. And we are seeing more investors that are interested in ESG analysis of traditional type of bonds, whether it's a bond that is backing a city, a state, or even companies. And they're to varying degrees. They're making social judgments. You've got funds that say, I don't like guns. I don't want any gun manufacturer in this fund, or I don't like fossil fuel. And so I think the danger that we see is that regulators begin to make begin to regulate without feedback from the market. And so I think the most important thing, and we believe that rating agencies have an important role to play here, is to constantly be working with regulators, with investors, with issuers, to make sure that we're looking at the best data that we have available and making sure we're looking at what's really happening and we're not chasing something down a rabbit hole, which I think can easily happen when it comes to ESG.
Just to finish off, because we're running out of time, this year marks the 50th anniversary of the BMA, and after lunch, Jeremy Cox is going to provide his reflections on the road ahead. So I thought as just maybe a few parting comments on your perspectives of how the BMA has played in shaping the Bermuda marketplace that we actually have today. Steve, could I ask you to?
Sure. I mean, I've been here now on and off for 22 years, thereabouts, it seems. And to me, the BMA plays the ultimate role in what perpetuates Bermuda as a market and has done a great job of continuing to allow Bermuda to be that. I think we used to use the phrase of the insurance laboratory of the world, the innovative, the places where I think you heard earlier Brian talk about the fact that if you say, I've got an idea, it's going to happen in Bermuda, here's where we go, there isn't a pause. Someone doesn't say, oh, well, hang on, it's going to happen in Bermuda. The market has been established, yes, by virtue of its participants and its service providers, the PwCs, the law firms, but in large part by a sense of strong regulation, a sense of flexible regulation, increasingly respected regulation around the world. And from a very specific and personal perspective, I think Bermuda has taken the approach of truly being a global regulator in respecting the concept of fungible capital, of consolidated regulation, of those things that I think make our industry more viable, which is that if we can share and take benefit of the correlation of risks or the absence thereof, we are stronger as an entity. And I think that Bermuda has been, relative to other jurisdictions around the globe, very on the front foot in that respect.
I think the BMA has been great at collaborating with the industry, the regulator, and the government, and I would encourage the BMA to continue that. They're bringing out new regulations that are impacting business like ours, as we speak. That collaboration that has made Bermuda great, we continue that. Bermuda's going to continue to thrive as a market, and with the support of the regulator, and confident that that's going to continue to be the case.
We love the environment. It's innovative. They're encouraging. We were a 7-year-old company when we first came here, and our competitors were all 100 years old. And the BMA listened to what we had to say and didn't judge us by, oh, you haven't been in business for 100 years, therefore you may not know what you're talking about. And so we find it to be a terrific environment to do business.
As someone who deals with the regulators in almost every major insurance and reinsurance market, the level of collaboration and constructive cooperation that you get in a regulatory discussion here in Bermuda is meaningfully different than you get anywhere else.
Well, leaving on that very positive note, Steve, Jim, Jeff, thank you very much for your time. I really appreciate it.
Thank you.
Thanks, Matt.